One of the biggest questions that I find traders asking me is, where should I place my stop loss? Now, I think about this question in many different ways, and one of the first things that I think of when traders ask me that question, no offense, I'm respectfully saying, but traders are really greedy. For some reason, this industry is all about getting the tightest stop loss, where I can enter the sniper entries, who's got the biggest risk to reward ratio. And when I really think about it, I think to myself, what's the point? You're here to make money, you trade to make money, you're looking to substitute your trading business with your 9 to 5, gain back your time and get some freedom. Why do traders constantly chase small stop losses? Well, I fully understand it, but why? Well, they want bigger risk to rewards. They want to risk as less as they can to gain as much as they can. But then it makes me think about this question. Why do so many traders get stopped out? Or why do so many traders lose so much money? And I think the answer to that question goes back to what I said in the beginning. Traders are very, very greedy. Now, I hear all of these things about institutions stop me out, banks stop me out, stop hunts, all of that rubbish. Now, it does exist. So I don't want any debates in the chats. I do agree with you, but there's got to be some give and take here. Now, nobody knows where the institutional levels are. I don't care what anybody says, nobody knows where they are. And to be brutally honest with you, I don't think banks even decide a specific level. It's an area in the market where they choose to trade from. Now, if we all understand how structure works in downtrends and uptrends, then if we respect those levels, meaning lower lows, lower highs, structural highs and structural lows, then you should be in a very good place to identify where you can be placing your stop losses. So before I continue rabbiting on, let's head over to the charts. Let's take a look at 3 examples, one using the 4H time frame, one using the hourly time frame, and one using the 1 minute time frame. What I'm about to teach you now are principles and concepts. So if you come here to figure out where you should be putting your stop loss based on the Holy Grail or a specific level, you're totally mistaken. I'm going to share with you some principles and concepts that I can guarantee you, if you apply them, you're going to make a huge difference, or it will make a huge difference in your trading. Let's head over to the charts. So the first example we're going to look at is Euro Aussie dollar. Now, there's a couple of things you need to factor in when looking for a trade. Number 1, market structure. Number 2, key levels. And number 3 is price breaking structural lows or highs. So the first factor is market structure, clearly making lower lows and lower highs. The trend is clearly down, respecting previous structural levels. And at this stage, price has broken a previous structural low. Now, once price breaks the low, what are we looking for? Well, we're looking for a retest of structure. So just simple market structure analysis, not going into anything too technical here. We're just simply waiting for the market to come back to our retest level, show signs of bearish behavior. Now, in this instance, we have the market structure in our favor, key levels in our favor, and we also have a break close below structure in our favor with a retest pattern. Taking the trade at this level, where should our stop loss be? Well, if we anticipate the market's going to make a lower high and a continuation down, we place our stop loss above this level here. We go for our targets. Now, let's say you take this trade and the market starts to move in your direction. What do you do in an instance like this? Let's say you've missed that trade. Well, this is what you can do. Because you expect the market to make a lower low and continue in a downtrend, you can execute your trade here. Now, I'm not telling you that this is the greatest of entries, but what I am telling you, it's still a good entry. Now, what would make this a bad entry? If you place your stop loss in the wrong place. Let's say you place your stop loss above this candle here because you just want it to go down. You're not following any market structure here, and you're just anticipating that the market should go down at this point. Do you deserve to be stopped out? Is a question you should ask yourself before you enter a trade. Well, the answer is yes, because in theory, if the market wants to pull back to make a double top of this structure, it can, and if it wants to pull back to make a lower high, it can, and that would eventually result in a stop loss. So where should your stop loss be? Above these key levels here. Now, this makes this trade completely fine to take. Now, what happens if you see the market continuing down and you miss this trade? Well, This is now a breakout trade. If you want to take this trade based on the breakout strategy, most traders will put their stop loss above the key level where price has recently broken out of, and then what they'll say to themselves here is that price in theory should not break above this level. But is that true? Well, no. If the market is trending down, making lower lows and lower highs, the price still can come back to some of these key levels here for a retest before continuing down. So does that put your stop loss in a safe place? No, it doesn't. What you need to be doing is respecting structure and putting your stop loss above the lower high. Now, granted, your risk to reward ratio is pretty poor here because in terms of your range and targets, you have a lot more to meet, but you know you have a safer stop loss. So let's say you take this trade, you continue to see the market pushing down. Would you enter in a push phase? Well, no, not really. But if you do, don't try and cheat the market. You do not want your stop loss here. You must put your stop loss above some of these key levels. Again, your risk to reward ratio is pretty poor, but if you place your stop loss here and you try to cheat the market, what eventually will happen? Well, more often than not, price will do one or two things. It will continue down, or price will eventually pull back. Well, in this instance, we won this trade, unfortunately, because I set it as 1 to 2, but the price will pull back to make a retest of structure and then go down. So if you took your trade with your stop loss like this, trying to cheat the market, let's say we was going for a 1 to 3 risk reward ratio here. Okay, there you go. What would have happened? You would have seen price push down, eventually you would have been stopped out. Could have managed that to break even. But the point is this, if your stop loss was above the key level, you'll still be in this trade, you would have been able to deal with the pullback, and then you'll be able to set yourself up for a new trading opportunity. Another retest of previous structure, stop loss above these levels here, and then again going for your targets. Now, let's say the market continues to push down again, and you've missed the best entry. Is it wrong to take a trade like this? Well, let's take a look at it. Absolutely not. But as long as you're not putting your stop loss above the candle or anticipating it to be a key level and keeping it above the major structure, you'll be completely fine to take this trade. And as you will see from these examples and hopefully these principles and concepts here, you would see how to survive in these pullbacks. You'll also be able to see how you can take trades respecting structure and market behavior. And as you can see here, because we identified the trend, the key levels, the retest, and we respected the structural highs and the retest levels of these markets, every single trade we took here won. Now, I'm not saying this is how you're going to trade in the live markets, but these are principles and concepts you need to consider. First trade won, second, third, fourth, fifth, and sixth. Why? Because when we placed our trades, guess what we did? It was above the key level, 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 it was above the retest key level, it was above the key level. So you can never enter a trade late, you can never enter the trade in the wrong position, and wherever you enter the trade, as long as you're trading along with the trend, it's always going to be the right trade. But what you have to consider is that your stop loss in a safe place. Let's take a look at another example on pound USD. We're not going to do the replay mode here, but same principles and concepts. We have here higher high, higher low, trend is up. We have key levels where we want to see the market respecting when we get there. We also want to see key levels in the market where price is breaking above. So let's say you want to take this trade based on an uptrend, key levels being respected and price breaking above. You could take an entry here. As long as your stop loss is below this key level, you're completely fine. If you want to take an entry here, you're completely fine to take this trade as long as your stop loss is below the key level. You could take an entry here as long as your stop loss is below the key level. Now again, your risk to reward ratio gets skewed a bit, but in terms of surviving the trade, making sure that you give yourself the best possible opportunity to win the trade, you set yourself up for a very, very good chance of getting the results you're looking for. This is on the 4-hour time frame. Let's take a look at the 1-minute time frame on USD JPY. We can clearly see the 3 principles and concepts we need to look at. We're seeing the market creating a downtrend, making lower lows and lower highs. We're identifying the market creating breaks below structures, and we're also identifying the market here respecting key levels. Let's say you're planning to take this trade. The best place to take this trade is here, as long as you have your stop loss above structure. If you want to enter the trade down here, it's completely fine, as long as you have your stop loss above structure. If you want to enter the trade down here, it's completely fine, as long as you have your stop loss above structure. And as you can probably see here from these examples with one more, let's say you want to enter the trade down here, as long as you have your stop loss above structure. As you can see from these examples here, you again would have been completely fine to take these trades. Even though the risk reward ratio is a bit skewed here, you give yourselves the highest probable chance of winning them. So what's the point I'm trying to make? Don't cheat the market. Respect your key levels, respect your structural highs, and wherever you plan to enter the market, just make sure that you're following what the market does on a daily basis. In a downtrend, it makes lower lows and lower highs. In an uptrend, it makes higher highs and higher lows. If your stop losses are in the right place and the markets are trending, then guess what, my friends? You will set yourself up to win a lot more trades than you already are, and you would avoid being stopped out and then seeing the markets go in your direction. So I hope you guys enjoyed that video. Maybe I should have looked at you when I done that summary, but I hope you get the point. And if you did enjoy this video, make sure that you hit that like button, subscribe if you're new, turn on notifications, and just a disclaimer, what I'm teaching you now is of my own opinion, it's not financial advice. So I'll always advise every single one of you to go and backtest 100 trades, put your stop loss in a safe place, and see what your results will be like in 2021. Continue to trust the process.